Many people believe that building wealth is a game of numbers, a complex puzzle solved only by those with advanced degrees in finance or access to secret market information. They chase hot stock tips and complex investment schemes, thinking the secret lies in some hidden formula. This view is fundamentally flawed. Wealth is not primarily built on what you know, but on how you think. It is a consequence of a specific mental framework, a blueprint that guides decisions not just in finance, but in all aspects of life. The average person focuses on earning more to spend more, while the wealthy focus on building systems and mindsets that generate wealth independently of their daily labor. This mental blueprint is not about genius-level intelligence. It is about adopting a different perspective on risk, time, and failure. The world is full of intelligent people who struggle financially because their mental models are fragile and short-sighted. They react to market noise with fear or greed. They see setbacks as final, and they underestimate the slow, powerful force of compounding. In contrast, those who build lasting wealth operate from a foundation of robust principles. They understand that the map is not the territory and that real-world outcomes are governed by uncertainty and randomness, which they learn to navigate rather than predict with false precision. The core difference lies in moving from a reactive to a proactive state of mind. Instead of being a leaf tossed about by the winds of economic change, you become the sailor who adjusts the sails to harness that wind. This involves a conscious effort to cultivate specific mental tools. These are not get-rich-quick tricks. They are enduring philosophies that build resilience and create opportunities over the very long term. It is the difference between playing checkers and playing chess. One is a game of simple reactions, while the other requires foresight, strategy, and an understanding of second and third-order consequences. True wealth is the byproduct of a well-constructed mind. Therefore, the journey to financial independence begins not in a bank but in the mind. It is about discarding the fragile, conventional wisdom that keeps most people trapped in a cycle of earning and spending. It requires embracing uncertainty, learning from disorder, and prioritizing the long, patient accumulation of both knowledge and capital. Before you can build an empire of assets, you must first construct the unshakable mental fortress that will support it. Wealth is less about the money you have and more about the mindset that allows you to generate and preserve it, regardless of the chaotic world around you. Most people operate on a first-order basis. They see an immediate problem and apply an immediate solution, focusing only on the direct consequence of their actions. For example, they feel stressed, so they buy something for a quick dopamine hit. They see a stock rising, so they buy it, fearing they will miss out. This type of thinking is simplistic and often leads to unintended negative outcomes down the road. The purchase creates debt, and the hot stock, bought at its peak, inevitably crashes. This is the path of the novice, the person who only sees the first move in a complex game and is perpetually surprised by the opponent's response. Wealthy mindsets, however, are built upon the foundation of next-order thinking. This is the ability to think through the chain of consequences that will follow a decision. It is asking, "And then what?" repeatedly. A first-order thinker sells stocks when the market panics to avoid further losses. A next-order thinker considers the second-order effect. Selling at a low point locks in losses and removes the opportunity to gain from the eventual recovery. They also consider the third-order effect. This panic selling reinforces a bad habit, making them more likely to repeat the mistake in the future, thus sabotaging their long-term financial health. Consider a practical business example. A company might choose to cut its research and development budget to boost quarterly profits, a classic first-order decision that pleases impatient investors. The second-order consequence, however, is that the company falls behind on innovation. The third-order consequence is that competitors develop superior products, market share erodes, and the company eventually fades into irrelevance. The initial win of a higher quarterly profit leads to a long-term catastrophic loss. A strategic thinker, a true wealth builder, understands this dynamic and willingly sacrifices short-term praise for long-term dominance and survival. This skill is not innate. It is a discipline that must be cultivated. It requires slowing down your decision-making process and resisting the urge for immediate gratification. Before making any significant financial or life decision, take the time to map out the potential consequences. What happens next? And after that? And after that? By training your mind to see the full chessboard, you move from being a pawn, reacting to the moves of others, to becoming the player who strategically positions their pieces for victory several moves ahead. This foresight is a superpower in a world obsessed with the immediate. The average approach to risk is deeply flawed and symmetrical. People either avoid risk entirely, stagnating, or they take foolish risks with limited upside and massive downside, like gambling in a casino where the odds are mathematically stacked against them. They seek small, certain gains while exposing themselves to catastrophic losses, often without even realizing it. This is the equivalent of picking up pennies in front of a steamroller. The potential reward is tiny and finite, while the potential risk is ruinous and total. This is a game you will eventually lose, no matter how nimble you think you are. The wealthy, particularly those who are self-made, understand and exploit the concept of asymmetric risk-reward. They hunt for opportunities where the potential upside is vastly greater than the potential downside. This is not about avoiding risk, but about being intelligent and selective about which risks to take. The goal is to structure your bets so that if you are wrong, the loss is small and manageable. But if you are right, the gain is disproportionately large, sometimes 10 times, 100 times, or even 1,000 times the initial investment. This is the logic of venture capital, but it can be applied to many areas of life and personal finance. Think of an author writing a book. The downside is the time and effort invested, a finite and known quantity. The author will not go bankrupt if the book fails. However, the upside is nearly unlimited. A successful book can sell millions of copies, be translated into dozens of languages, and lead to movie deals and speaking engagements, generating wealth and influence for decades. The risk is capped, but the reward is open-ended. This is a beautiful example of a positive asymmetry, often referred to as a barbell strategy. Keep most of your assets safe from harm while making many small, calculated bets on high-potential opportunities. This mindset requires a complete reframing of failure. In a world of asymmetric bets, frequent small failures are not just acceptable, they are a necessary part of the process. If you make 10 bets where the downside is -1 times and the upside is +20 times, you only need one to succeed to come out far ahead. The other 9 failures are merely the cost of finding that one transformative success. This approach removes the emotional sting of loss and turns investing and entrepreneurship into a game of statistics and patience. You are not trying to be right all the time. You are trying to be right once in a way that matters. Life is, inherently volatile, uncertain, and honestly, pretty chaotic. Most people and systems are fragile. They break under stress and disorder. Think of a teacup. When dropped, it shatters. A person with a fragile financial plan sees their world crumble during a market crash or after a job loss. They seek stability and predictability, but because the world offers neither, they live in this constant state of anxiety, always trying to protect their delicate structure from the inevitable shocks of life. A step up from this is resilience or robustness. The resilient object, like a rock, withstands a shock and remains unchanged. This is better, sure, but it does not benefit from the event. There is, however, a third category, one that the wealthy intuitively understand and cultivate: anti-fragility. The anti-fragile is the exact opposite of the fragile. While the fragile breaks under stress and the resilient stays the same, the anti-fragile actually gets stronger. Think of the mythical Hydra. When one head is cut off, 2 grow back in its place. Human muscles are anti-fragile. They grow stronger when subjected to the stress of weightlifting. The key is that anti-fragile systems don't just survive volatility, they feed on it, learn from it, and grow more powerful because of it. This is, in my view, the ultimate mindset for a world defined by unpredictable events. In finance, an anti-fragile portfolio might consist of a safe, stable base combined with those small, asymmetric bets we discussed. When a market crash occurs, a moment of extreme stress and disorder, the fragile investment is wiped out. The anti-fragile investor, however, might lose a small amount on their speculative bets, but is then positioned with cash reserves to buy high-quality assets at deeply discounted prices from the panic sellers. The crisis for them becomes the single greatest opportunity for wealth creation. Their system is designed not just to survive the storm, but to harness its energy to leap forward. This concept extends far beyond money. An anti-fragile career involves developing multiple skills and income streams, so the loss of one job becomes an opportunity to focus on a more promising venture. An anti-fragile mind does not fear mistakes or criticism. It seeks them out as valuable feedback, a source of data to become smarter and more effective. By embracing this mindset, you stop fearing randomness and start seeing it as a source of fuel. You transform adversity into a threat. You emerge from the ordeal not just intact, but significantly stronger than before. Compound interest is often called the eighth wonder of the world, and most people honestly associate it purely with money. They understand that investing a sum of money allows it to grow exponentially over time, as the interest earned begins to earn interest of its own. It is a slow process at first, almost imperceptible, but over decades, its power becomes immense and transformative. While this is a cornerstone of wealth building, the truly wealthy apply this same powerful principle to something far more valuable than capital, their knowledge. They understand that learning, like money, compounds. Every new concept you learn does not just add to your knowledge base. It multiplies its value by connecting with everything you already know. Learning about mental models from psychology enhances your understanding of market behavior in finance. Studying history gives you a better perspective on economic cycles. Mastering a new language opens up new business cultures and opportunities. Each piece of knowledge builds upon the last, creating a complex, interconnected web of understanding, a latticework of mental models that allows you to see the world with a clarity that is unavailable to the specialist who knows a great deal about very little. This process requires a commitment to continuous lifelong learning. The wealthy are voracious readers and learners, not for entertainment, but for application. They dedicate time every day to expanding their minds, knowing that the dividends are enormous. While the average person stops actively learning after their formal education ends, the self-made millionaire or billionaire sees their education as just beginning. They are not just accumulating facts, they are building a more sophisticated machine for thinking, one that can solve more complex problems and identify more subtle opportunities. This intellectual capital is the ultimate asset, as it can never be taken away. The effects of this compounding knowledge are subtle at first, just like financial interest. For years it might seem like you're not getting anywhere, but then, one day, the connections snap into place. You start to see patterns that others miss. You can anticipate trends, navigate complex negotiations with ease, and build systems that are both robust and innovative. Your judgment improves dramatically. This is the unseen multiplier at work. The small, consistent daily effort of learning compounds into a formidable intellectual advantage that makes the creation and preservation of wealth seem almost effortless. The financial markets are not just a reflection of balance sheets and economic forecasts. They are a vast global arena where human emotions play out on a grand scale. The two most powerful of these emotions are fear and greed. Greed drives bubbles, causing people to pile into assets at absurd valuations, convinced that this time is different. Fear drives crashes, causing those same people to panic sell at the absolute bottom, terrified of losing everything. These primal animal spirits are the greatest enemy of the investor. They are the internal saboteurs that compel you to buy high and sell low, the exact opposite of what is required to build wealth. The ability to recognize and control these emotions is perhaps the single most important skill in investing. Wealth is often the transfer of money from the impatient to the patient, from the emotional to the disciplined. A wealthy mindset is not one that is devoid of emotion. It is one that has built systems and rules to prevent emotion from dictating action. This means having a clear investment plan and sticking to it, especially when it feels most uncomfortable. It means automating your investments so that you are buying consistently, whether the market is up or down, a strategy known as dollar cost averaging. This emotional control is a form of internal anti-fragility. When the market is gripped by euphoria and everyone you know is bragging about their gains, the disciplined investor feels the pull of greed but resists the urge to abandon their strategy and chase speculative returns. When the market is collapsing and the news is filled with doom, the disciplined investor feels the icy grip of fear but sees it as a signal of opportunity, a time to buy when others are panicking. They have trained themselves to be greedy when others are fearful, and fearful when others are greedy, as the famous saying goes. This mastery is not achieved overnight. It is forged in the fire of market cycles, through mistakes made and lessons learned. It requires deep self-awareness and the humility to admit that you are susceptible to the same biases as everyone else. By creating rules-based systems, checklists, and principles, you build a fortress around your decision-making process. This ensures that your actions are guided by logic and long-term strategy, not by the fleeting and treacherous emotions of the moment. Taming your own animal spirits is the price of admission to the club of long-term financial success. Ultimately, the mindsets that build wealth are not shortcuts or hacks. They are a commitment to playing the long game in a world that craves instant results. True wealth, the kind that lasts for generations, is a marathon, not a sprint. It is built brick by brick through decades of patient saving, intelligent investing, continuous learning, and emotional discipline. The forces of compounding, both in knowledge and in capital, are immensely powerful, but require an enormous amount of time to work their magic. Patience is therefore not just a virtue, it is a strategic necessity. It is the secret ingredient that activates all the other principles. This journey is never a straight line. It will be punctuated by setbacks, failures, market crashes, and moments of profound self-doubt. This is where resilience becomes paramount. Resilience is the mental fortitude to get back up after being knocked down, to learn from your mistakes without being defeated by them, and to stay the course even when progress seems impossibly slow. It is the understanding that failure is not the opposite of success, but a part of it. Every wealthy individual has a story of a major setback that tested their resolve. Their wealth is a testament not to their ability to avoid failure, but to their resilience in overcoming it. These principles, patience and resilience, do more than just build a bank account. They build character and lead to a more fulfilling life. A person who has mastered their emotions, who sees opportunity in chaos, who thinks in decades instead of days, and who learns from every experience is not just wealthier, but wiser. They are less stressed, more in control of their destiny, and better equipped to handle whatever challenges life throws their way. The pursuit of wealth, when guided by these mindsets, becomes a framework for personal growth and self-mastery. The financial freedom that results is not an end in itself. It is the means to an end, a life of choice, purpose, and impact. It is the freedom to spend your time as you see fit, to pursue your passions, to support your family, and to contribute to causes you care about. The mindsets of the rich are not about hoarding money. They are about building a life of strength, independence, and meaning. By cultivating patience in a world of immediacy and resilience in a world of fragility, you are not just unlocking wealth, you are unlocking a richer, deeper, and more satisfying experience of life itself.